And all eyes are on the Federal Reserve as we await a decision on whether the U.S. will see a rate cut or not. We're joined by Nate Thooft, the CIO and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us.
Great to be here.
It's pretty much, are we at about 110% that there'll be a rate cut tomorrow?
I think it's a pretty good certainty that we're going to get a cut tomorrow. The messaging, obviously, as well as expectations going into next year, is what's ultimately going to matter. And I think the market, they priced in the cut now, but I think they're also expecting a bit more of a hawkish tone as it pertains to what's next for the Fed.
What do you think they want to hear?
Well, I think the market has a fairly low bar because, first of all, they're expecting and have priced a cut. And second of all, I think the market is expecting a bit more of a hawkish tone driven by what we've seen in the rates market, particularly further out the curve over the last few weeks. So I think the market will accept pretty much anything as long as it's within that more slightly hawkish to leaning more towards dovish. If it becomes very aggressively hawkish, as in we're basically on hold for longer, that will be problematic for the market. But I think other than that, we're in a pretty good spot from a market perspective.
And for cuts, what would they like to see over the next in 2026?
So we're pricing about 3 additional quarter-point cuts in 2026. I actually think the risk is for more, and a lot of that's going to depend on the makeup of the Fed. So you have what I would define as the pre-Powell era, as the Powell era, and then you have what will be the post-Powell era later next year. The risk is, or the potential benefit, depending on how you want to look at it, is there is more room to go further lower if you end up with a Fed that becomes more comprised of individuals that are more tailored towards a lower interest rate level, which is certainly what the Trump administration would like to see. But also, I think parts of the market would appreciate a lower level of yields as well, which will be driven by the makeup of what the Fed looks like once Powell is no longer chair.
Now, how much of an influence is the president on decisions and the market as well? Because they have to make these decisions based on the numbers they see, but then they also have this external pressure. How do they balance that, whoever the next head of the Fed will be?
Yeah, I know it's an interesting question because the reality is the president and administration can say what they want, but I truly do believe that the Fed believes they are an independent agency, regardless of who's necessarily in charge, particularly with the candidates that are on the table right now for the next possible chair. They will remain independent. Now, with that said, that doesn't mean the Fed can't align themselves with more of the views and or what should be focused on as it pertains to what drives interest rate cutting or hikes. And if we get a Fed that's much more focused on concerns around growth and concerns around employment and less concerned about inflation, you still have a broader narrative where you can have rates lower than what the current Fed is thinking. And this was predicated on the fact that there are reasonable scenarios where someone could come in and say, we can afford to have a lower general interest rate because we believe the neutral rate is a lower level than what the current Fed believes. And it will still be figured out through the core functions of what the Fed should be focused on versus driven by what others or the president might be saying.
And I want to get on talk about, we're starting to see data again from south of the border. Is that going to be a factor at all? Anything that we're seeing over the next month, say?
Yeah, the data is still a bit murky, although, as you said, it is starting to get populated again. I think, generally speaking, we are in a period where we're going to see slightly weaker data, particularly when it comes to jobs data, as well as some of the data around housing and even potentially consumers type of things. So that data will generally be supportive in our view of allowing the Fed to continue to cut into 2026. The wild card is still inflation. And we do believe that inflation will remain sticky, but it will not be so problematic that it will cause the Fed to want to pause or outright stop cuts anytime soon. We have an environment where there's a lot of offsets in inflation, particularly as it pertains to housing data, that will keep inflation generally under control in our view, even though it might be slightly elevated relative to Fed expectations.
So is that 3% then? Is that what you're thinking for under control?
We're roughly talking about high 2s into basically 3% is comfortable for the Fed, even though it's not at their target levels.
And is that worrisome at all that it hasn't gotten back down to the target levels? They'd love to get it down below 2, right?
Well, they would like to, but I think there's a lot of structural arguments as why we might not get there. And we may be in an environment where we just have to accept that. I mean, the reality is we are going through a cycle where we're getting a bit more deglobalization. tariffs are on the margin, are inflationary, and we do have some structural drivers in the market right now that are basically keeping inflation slightly elevated. But the reality is, I don't think an inflation level around 3% is particularly problematic. And in fact, in some cases, actually is a positive because you do still have growth in overall costs, and you also likely have growth in wages as well, driven by some of that inflation.
All right, so heading into 2026, what's an investor to do?
Well, we are a bit more cautious next year. And the main reason for that is we've had such a strong risk-on environment for quite some time, including 2026. So we're much more focused on higher quality next year. We still think there's upside in equities. We still think there's money to be made in the bond market. But we're definitely gravitating by taking some chips off the table with more speculative areas of the market and focusing on high-quality areas, such as healthcare, such as high-quality tech, mid-caps in the United States and globally have much more attractive valuations. And we do expect a bit more broadening in market participation versus just being driven by the Mag 7 that we've seen over the last 12 months.
Okay, we're going to have to wrap it up there, but Nate, thanks as always for joining us.
Thanks for having me.
Nate Thooft is CIO and Senior Portfolio Manager at Manulife Investment Management.